Hello everyone, this is Mayank and welcome back to my channel. So today we'll discuss about a particular concept called carbon credit trading, or briefly called CCT. We'll take the example of a 60x backer stock from Indian stock market. The stock has given return of around 60x in a period of roughly 1 year, and the stock has a potential to give even more than 60x return also in the future. But before we jump into the stock discussion, we need to understand various concepts with respect to that stock. First is carbon credit trading. What is CCT? Why it is so important? The rationale behind it and the key growth driver for the entire sector. Then we'll come to the stock. We'll understand the fundamentals of the stock. We'll understand about the stock, where it fits in the entire CCT paradigm, and how this stock can perform, the strength of it, and then we'll understand the weakness of it, what the risk involved in this particular stock. So this video can be a lengthy video because a lot of things are there, and CCT is a topic which is not very much discussed in day-to-day life. So day-to-day we can discuss about FMCG because we are more connected to that particular concept of FMCG market. We can discuss about consumer durables also because we all have kind of AC or cooler or refrigerator at our home, so we connect to those products. We can discuss about automotive sector also because a lot of have bikes, cars, most of us have it or more accessible to them, so we know about those things. But carbon credit trading is not something which we are very accustomed to or which we directly deal with. We need to understand the entire thing in detail. So again, first request, watch the entire video to get entire details. Don't leave half, because either you like it then watch the end. If you don't like it, they can drop off. But if you want to understand more, then watch till the end. Second thing, even if you watch till the end, don't just go and invest. Do your own research, understand the entire thing very deep level, and then if you find it worthy, then only invest in the stock, or you can leave the stock because it can be a risky bet if you don't understand. And one more thing is that if you think this video is helpful for you or anyone you know it can be helpful, please don't forget to share it with them and like the video if it's helpful for you. And if you're new to the channel, don't forget to subscribe and hit that bell icon so that you get notified whenever I publish any new video in this channel. Before we jump into CCT, you need to understand what is ESG. So ESG has been quite a big thing right now for last 2-3 years, because ESG stands for environmental, social, and governance first thing. So ESG has been governed by some major organizations or major hedge funds like BlackRock, and then it's been supported by consulting companies like McKinsey and all. So they says that I'll just read it's Economic Times screenshot. You can also go there and check that. I'll read line by line. Okay, so environmental, social, and governance, or ESG, is a form of sustainable investing that measures the impact of a company's ethical contribution to its stakeholders. Okay, ESG investing is based on the idea that only pressure from large investors can force the corporate world to behave responsibly from a social, environmental, and governance perspective. In a nutshell, these big investors want company to follow some guidelines which is impacting environmental, social, global. Okay, and they think that this is the only way to make a company be responsible for its activities. Environment refers to the use of clean energy, waste management, and conservation of natural resources. It includes production of animals. Companies that follow energy harvesting by natural means in developing of its products leads to safety and preservation of our natural resources. Social criteria refers to business relationships. So overall, a company can be termed as good company if they follow ESG, and they can be termed as not so good company if they don't follow the ESG compliance. This is what they say. So there is a video by Mr. Ashwatharan Damodaran sir where he discuss about ESG and different ESG mode of investing. So you definitely should watch that video. I leave the link in the description. You'll understand why ESG is important and whether it is actually important or not, or shall we follow ESG is a pointer while choosing a stock or not. So watch that video. It's a very good video, and then we'll move further. So you understood ESG. ESG basically makes a company compliance to some social and environmental factors. Now, since it's about environment and social, let's see about carbon credit trading and its importance. So there is two kind of protocol: Kyoto Protocol, and there is something called Paris Agreement. So Kyoto Protocol was an international treaty, okay, which was signed in 1992. And then what happened? Then Kyoto Protocol is signed by roughly 192 countries. If you see the date, there's a meeting on in Japan, a place called Kyoto, 11 December 1997, and the entire agreement of 192 countries became into fruition on 16 February 2005. So, and the project failed due to non-inclusion of few developed nations, and Paris Agreement came into existence 2015. What was Kyoto Protocol? Kyoto Protocol was to reduce carbon emission. So basically 192 countries came together, signed one agreement to reduce carbon emissions so that they can make more environmental friendly decisions, and they can force some companies which are adding more carbon to the basic environment to reduce their emission. So this was the destination of Kyoto Protocol, but it failed for multiple reasons. One of them because they don't include developing nations in the entire agreement. Then came our Paris Agreement. So Paris Agreement says almost similar thing. So Paris Agreement, often referred to as the Paris Accord or the Paris Climate Accord, is again an international treaty on climate change. The Paris Agreement's long-term temperature goal is to keep the rise in mean global temperature to well below 2 degrees Celsius, above the pre-industrial levels, and preferably limit the increase to 1.5 degrees Celsius. Okay, so basically those two are same. Kyoto Protocol failed, so they came up with Paris Agreement. Again, the same thing, to reduce the carbon emission, to maintain a certain level of increase in the temperature. And overall, every country, total 195 countries have 196 countries have signed Paris Agreement. So together they will all try to reduce the temperature. This is something which everybody will together do. How they do is what called carbon credit trading. So because these two things are kind of enforced on these countries and they signed an agreement, now they have planned how to achieve that. To achieve that, there is something called carbon credit trading. So this is how carbon credit trading looks. So basically I'll explain this in detail kind of thing. Okay, but again I'll leave a link on the video in the description also, which you can watch to understand how this entire thing works in detail level. So I cannot go and explain this like that video. I'll give a brief description here. So forest and all, some kind of farm or some kind of organization, what they do carbon dioxide sequestration. Okay, sequestration is the process by which they store the CO2 inside the soil itself. Okay, now what they do, for every 1 million or some capacities are 1 million, I think 1 million kg, something like that, of CO2, if they store, they get one carbon credit, something like that. And one carbon credit costs around $100 in the European market, where it costs much lesser in other markets like South Korea and everything. Okay, so during the process of carbon sequestration, they store some carbon in the soil, that is measured through a process. Okay, they do some kind of analysis and everything, because of which they will get some idea on that, and for that they get some credits. So one credit they will sell to the companies, which are again responsible for emission. So basically, in a nutshell, if we are two people, me and you are two people, I am a person who do some good work. So every good work I do, I get a kind of credit. Okay, that credit I can sell it to you for doing some bad work, right? So if you do bad work, police will arrest you. But if you have carbon credit or good work credit in our communication, that time you get a permission from government to do a certain level of bad deed and will not get arrested. So again, it's a very conflicting concept, but this is how the entire thing works. So what the organizations and Paris Agreement people say, that we cannot control it, we have to reward people to do this. So first of all, the people who reduce the carbon dioxide in like sequestration, they get money because the carbon credit trading can be traded, and the companies, if they want to emit more, they have to buy this credit. Okay, so now what happens, every year that emission norms, the limit on that keeps on decreasing. So for example, there is X factor now, beyond which you cannot emit, that will reduce to X minus 10%. Next year will reduce to X minus 20%. So it will start getting reducing, and so you need more carbon credit to cross that level. So the demand of carbon credits will increase. So this guy, one side of the equation makes money because they need more credit, and second, also it becomes more costly because the credits are lesser and they need more right now. So what will happen now, since they don't get credit, they will reduce the carbon emission. This is what these guys planned, and to some extent it worked also. Mostly it worked in European region. Okay, but overall is still in progress. Okay, so this is how carbon credit trading works. You can see the cycle here. These guys do, the forest guys get some carbon credit. These guys sell it to the greenhouse gas emission, these factories and everything. In return, factories will pay money to these farms. Okay, so this is in a nutshell how carbon credit trading works. So we understood CCT, right? Now there are two kind of CCT. One is mandatory market, one is voluntary market. Okay, so mandatory market works something like this, and a voluntary market works something like this. Okay, in voluntary market, what happens? This countries doesn't enforce any industry to go for carbon credit trading or to reduce the carbon emission. They do it voluntarily. In mandatory market, what happens, government induce some kind of enforcement on these companies that you cannot go beyond this limit, because that's why if you see there is a dashed line mentioned here, beyond which you cannot go. So this is a carbon capping. Okay, so to go this, they have to buy some carbon credit so that they can cross this limit. Okay, so you can see this black lines is something which they are doing. To go to the green line, they have to buy that much of carbon credit. Okay, so to basically get this, so these guys, The green guys are selling the carbon credits, what they saved by not emission, and the red guys, they already touched this limit of dashed line. Now if they want to cross that much, to cross that they have to buy carbon credits. So these guys in the green are making money, so that they, because their emission is less and they saved some here, and the guys in the red are paying money because they have not saved so far and they have to increase their limit. Okay, this is mandatory market because this is enforced by, the limit is enforced by the government of that country. In voluntary market there is no limit as such induced by the government, but voluntarily this companies does this because they want to become ESG compliant. Okay, this is again ESG picture, that's why I discussed in the before why ESG is important. For mandatory markets, government is there to hold your collar and say that okay, you cannot go beyond this limit. Okay, but in voluntary markets where this CCT concept or any kind of carbon emission concept is not being so enforced, similar to India also it's not being enforced at all. But India also, if they want to enforce more, they will enforce voluntary first and then will go for mandatory. So most of the countries are voluntary now. So for a country which is voluntary, some big companies want to become ESG compliant, so they get money from big investors like BlackRock and all. To do this, they have to show the ESG compliant. To become ESG compliant, they choose voluntary market of CCT. This is how CCT works in two different ways. Okay. Now, what is the key drivers for growth? Key drivers growth for this particular sector. Why this particular CCT sector will grow? Okay. First, I told you ESG compliant. Okay, so these companies want to become ESG compliant, so they will go for become carbon. They'll start doing carbon credit trading, and this sector will grow. Second, focus to reduce global warming. This becomes mandatory compliant, right? The national governments in Union, they will force some kind of mandatory emission norms because of which to reduce the global warming. Then comes goal of net zero carbon emission. So by 2070, for example, India has given a mission that they will become net zero carbon emission country. There are some countries like Europe want to become by 2050. Okay, there is some country become by 2030 also. So there are a lot of countries which have different time frames to which they want to become net zero carbon emission country. And these things all are key growth driver for this sector because they have to go for carbon credit trading because the cap will come and the cap will start going lower and lower with each passing year. Next, NDC document by each country. Okay, so each country in the Paris Agreement signed one NDC document. Okay, in each NDC document they have specified that how are they going to reduce the carbon emission in their country. They have given some document and they say they pledged. Okay, so once you pledge, then you have to follow that pledge. To follow that pledge, they have to implement some steps, and CCT is one of the majorly driven step through which you can reduce this entire carbon emission. So this is how it works. Again, a small picture where somebody sell the carbon credit and they get paid. The guy who buy carbon credit, they use it for their emission. Okay, so see, you can see windmill here. Putting windmill, these guys get some carbon credit rating. It sells to a lady or guy maybe. Okay, to sell to take money, and that guy or guy will be used this particular for factory. Okay. Then there are few more reasons why. So there are 5 different markets of this particular what is it? This particular CCT. So international treaties, as I told you, Paris Agreement and Kyoto Protocols are international treaties which will force the growth of this particular market. Then domestic emission trading schemes. Okay, so every country will have the domestic scheme also, which will again force CCT. Then comes your international voluntary market. So for companies become ESG compliant, they'll go for international voluntary market. Then comes domestic market. So domestically also people will trade. For example, these two what you see, right? Both of them are in India and they want to trade among themselves, and they need somebody to do this entire. Now, as per the image, you are saying this guy, windmill owner, comes with some carbon credits selling to this person. There he's paying a dollar bill, but this doesn't work like this. There had to be a third party agent in the middle who does everything. Okay, so domestic market is also present for this particular kind of CCT concept. Now our company comes in the picture. EKI Energy Services, the company which we are going to talk today. So you have understood, I hopefully something I made it clear that what is ESG compliant, why it is responsible for CCT, why CCT can be in the future, what are different markets which drive CCT, and how a company or why a company need to follow CCT to become a lot of other like ESG compliant, all those things, right? So now everything has been discussed regarding CCT. Now we talk about the concept of our company, where our company sits in the middle. Previous slide I told we need an agent in the middle. So EKI is the agent basically. So what happens? Company B are the guy who produce a lot of carbon emission, bad guys. Company A are the good guys. Okay, they have some carbon credits. Okay, so they are the sellers. This company B becomes the buyers. Who becomes the agent? Broker, EKI. EKI is the broker. EKI does provide all the services, consulting services, like how much carbon credit you need, where do we get, how do I find the sellers, what is the carbon credit percentage, and all those things that you'll find out. A lot of consulting services they do. We'll see in the later end of the video. And then it's in the middle and it gets commission, or it what two ways it gets commission. First, consulting services get paid. Second, it buys the carbon credit from company A and sell it higher prices to company B. So this is the other way it deals. So EKI sits somewhere in the middle of these two companies, and EKI trades. Okay, EKI helps in trading carbon credits from one party to other party. This is where our company sits in a nutshell. So further, if you see what industries EKI services works: biomethanation, renewable power, waste management, energy efficiency, and energy efficiency. I don't know why I read twice. Okay, but basically these 4 sectors or 5 sectors industries, this EKI energy services work. What services they provide? Provide validation, registration, monitoring, verification, issuance, and supply of carbon credits. I'll explain you in a nutshell. Like if I have a farm, for example, I have a farm where I say, okay, I have this many carbon credits, but nobody will believe me. So they include some kind of third-party services to validate that. IKEA is the one who does this also. Then they want to register. So I'll give you the link to the video. You'll watch that. But for any company or any farm to say that we are a carbon negative farm, so we have carbon credits, they have to register. They have to register within an organization. So this company has a registration process. Then monitoring. How monitoring comes into picture? Let's suppose I say that this year I have this much carbon credits. It's verified and everything. What about next year? What about next to next year? Right? They will say we have, but that doesn't mean it's there, right? So there is a kind of scientific process through this testing and everything does, and that's how they monitor whether the soil has carbon trapped inside or not. So that is becomes monitoring. Then comes verification and issuance. So basically this company comes, they verify your soil, they take a sample, it goes to some process, they verify and find that whether this soil has carbon dioxide or not, or how much they have. They will verify. After the verification, they'll give you issuance certificate. So that certificate is basically called credits. And then they will take your credit, X amount of money, they will sell it to some, they'll sell all this information to some kind of buyer and give you credits also at a certain price. So this company earns in two ways. First, this entire consulting services, and they make certain margin on the carbon credits also. How EKI Energy Services works? Okay, so there is a client who is basically generate the carbon credit. So client will select EKI as part of the process. Parallel, they will do the project identification. Okay, then project implementation, then project operation, and they will generate all the required carbon credits. So what EKI does? EKI does the documentation part, then do the validation and endorsement part. For validation, they use DOE, which is designated operational entity, and the DNA is designated national authority, which is called MOEFCC in India. It can be different in different other countries. Then they do selection of DOE for validation. So validation documentation part they do in the first step. Then do move towards registration. So after registration is complete, okay, they goes back to the client and they monitor the project activity. So after the monitor project activity, their verification and certification is done by the DOE. So EKI helps in the verification and certification of these carbon credits with the help of this DOE. So EKI helps in that, and clients gain some certificate of carbon credits. Parallelly, what EKI does, the EKI helps in finding the buyer. So this is the step. Then they create a contract with buyer and they sell the carbon credits. Okay, so here's the carbon credit. It goes through here. Carbon credits, they like after certificate they get the carbon credits. That carbon credit they sell it to the buyer. Okay, so these are the steps what basically cycle what EKI goes through. So the entire process of a client, basically entire process of a client who generates the carbon credit. Okay, so this is the client is who generates carbon credit, and there is a buyer who buys carbon credit in the entire thing. So EKI does all these things in the middle, and they get paid for all this entire consulting services. So they act the bridge. Okay, so this is how EKI does and everything in the middle. Okay, and now let's move to next slide. So next slide again says how EKI Energy works. So which are the countries they are present? So Mexico, Brazil, Argentina, Switzerland, Ghana, Kenya, Turkey, Jordan, Egypt, India, UAE, Thailand, Vietnam, Singapore, Indonesia, Philippines. So these are the countries which basically EKI Energy works with. India is something which, like, so if you say major out of these countries, major is UK. Okay, so UK works a lot on this, like they have a very strong norms as such, but they are not doing very great in UK. If you ask me, they are mostly into developing countries. So they buy carbon credits from developing countries and sell it to developed countries. This is what they are doing. but the market in Southeast Asia and India is going to become very big in the future. We'll see that also in the coming slides. Now, if you see numbers of how EKI, so EKI I told does a lot of things, right? So how these things played out in case of number. So between quarter 1 FY22 and quarter 1 FY23, the jump in the revenue is 162%. And similarly from FY21 to FY22, like yearly jump, it's a jump of 843%. EBITDA, if you see this company, why FY22, FY21 here? Because this company listed in FY21 itself. That's why the data is only from FY21 from the perspective of stock market. EBITDA, if you see in the same kind of time frame, quarter on quarter, if you see, it's 191.1%. Okay, year on, so it's not quarter, it's year on year. And then if you see full year changes, there's 1936%. That means they double their revenue margin by 200%. Okay, so 2000%. And then profit after tax, if you see, it's also similar, 1950.1% on the similar year, full financial year cycle. If you see year on year, it's almost doubled, tripled basically, 199.17%. So this is how the numbers look like. Moving forward, if you see numbers game here, then ROC, if you see 19 before the listed was 53%, then become 139%, then become 153%, and last year it was full year it was 236.7% is the ROC. ROE, if you see, is 176.5% increased. And then if you see 0.6% was cash flow, like operations cash flow. And then by 2022 they have generated cash flow of 30.3 crores. And in the debt balance, if you see in financial year 22, their debt is only 0.8, where their cash is 9.4. That means they are completely a cash free company. They had always been a cash free company. If you see in 19, they had only cash of 0.6, but their revenue of debt of 1.0, little more. But financial 20 onwards, their cash and debt has become reversed. They had always more cash than their debt. So it's always been a debt free company. Why they're debt free company? Because one of the major reasons they are very asset light model. Okay, we'll discuss that also. So this slide talks about more of the opportunity in the entire sector. As we told before, we discussed before also, net zero emission pledge by different countries. 90 plus countries have decided by 2050 to go for net zero emission. So this gives a boost to the sector. Then growing usage. So companies are increasingly using internal carbon pricing to reduce carbon emissions across their value chains. Okay, so the usage of this carbon trading credits are more and more in numbers. India's climate commitment. So from India's perspective, India has already committed, but there is no kind of framework been discussed. But it's a hope that by 2022 or 23 first quarter, they will give some amendment or give some kind of policy which governs this particular thing, climate change regarding carbon credit trading or things like that. Then regulations. Many countries are very strict regulations regarding carbon emission. It was not that strict, but with passage of time, they make it more and more strict. And then new business avenues. This is the sector which I am not very happy with what they are saying. This looks like more of a facade to me. So I'll explain what they are saying. They are saying green cooking, LED, clean water, etc. for nature-based projects, forest, sustainable agriculture, waste management, green hydrogen, etc. So this is what they are saying that EKI is doing. So basically, they are launching some ICVs, some cooking cooktops and all, which are environment friendly. Then going to plant some trees and everything to make more environment friendly. And they are saying they'll generate some carbon credit from them. So the carbon credits generated from this kind of initiative are not that big in number, so that they can make a lot of money from them. It looks more of an NGO kind of activity where they support some communities. So this is the industry opportunity. Now comes to EKI, what is the strength? So they have a domain experience management. If you look in the management of core management of EKI, a lot of people are from them are the people who have done in the environment sector for last 15-16 years. They have worked in the carbon credit and the carbon market, so they know how this sector works, how this entire, and they have the required connections also to make a mark in this sector. So they have a very good management for this sector. Okay, so any company who doesn't have a good management belonging to this sector might not do good. So which is not the case of EKI. They have very good management. Then they are an integrated company. So they do a trading and advisory, and they have backward integration also. So backward integration, when I say these kind of initiatives of giving induction, giving kind of environment friendly cooktops and planting trees and all those things, it also helps them to get some carbon credits. So they generate the carbon credit themselves also, and they try to sell it. Okay. Second part, they do trading as well as advisory. So when they advise on everything, they can buy carbon credit from the seller, keep it with them for 1 or 2 months, then sell it to the buyer at a difference of prices. So this helps to make them money, the difference of price, which is called trading. They can make money there also. So they are both trading and advisory as well as some kind of backward integration. Then comes our asset light model. So this I told before, Now this company does not do any kind of carbon credit generation, right? So they only do trading and advisory services. So they have only employees who are consultants. So they work like consulting company. Consulting company are very asset light model. They have major expense for them is their employees only. So they can go high and low anytime depending on the demand. So though they don't have a infrastructure as such, whether to take care of electricity bills or machinery cost and things like that. So they are a very asset light model. The moment they get more projects, they can hire more people. If they have lost some projects, they can fire those people. So they are very flexible with their assets. So that's why they are asset light model. Then comes they are a very diversified market. Is that they are present in many countries. So they are in a very diversified market and they don't have to rely on any particular big country. So even if something goes in one country bad in other country, there are a lot of many other countries support that. Okay, so a very diversified market. Then some market size. With the market size, 150 plus countries still to be explored. Okay, there are only few countries. 150 plus countries, something which they can target more. It's a huge market. Then there are only two emission trading schemes which works very well right now. One is European Union, which is very strict in carbon credit trading, and they are kind of matured also. Second best is South Korea. Even US doesn't have a very good carbon trading exchange, okay, or schemes. They have only very nascent stage right now, but in India, country like India and all that don't even exist right now, okay. But there's always scope for these countries to come, okay. So there are a lot of other emission trading schemes which can be launched in many countries, and they can get benefited by that. Then comes 58 billion carbon credits per year. As per their statement, if you see, they will need the Earth or the entire Union of Paris Agreement will need around 58 billion carbon credits per year to optimize the emission of carbon, out of which the international market size can become $100 billion in next 1 to 5 years. Now this is it's not like after 10 years or 20 years. This is only required from next 1 to 5 years. 58 billion carbon credit, and compared to this company has done only 87 million carbon credits in the last year. So if you see the difference, the huge difference, right? So this is the potential from 87 million. They can reach up to 58 billion per year. Now I'm not to say that 58 billion will be done entirely by them. So that is a different kind of risk also what we can see in this stock, that on the potential side they can do a lot. Even if you do 10% of it, they have a potential of around 5.8 billion per year. If you see a span of 5 years, then they will do close to around 25 kind of 30 kind of billion credits in the span of 5 years. So that's a huge market for them. So just next 1 5 or 20 billion credits is something which they can do. So out of 58 billion carbon credits, they are assuming that around 30% or 40% only is something which is required by carbon credit trading, but remaining the countries will do it within themselves. So example, India, this cement factory, and there is a farm. So farm can sell it to the cement factory, and cement factory can buy from the farm. So it's settled within India, or they might do it themselves. Then so after which only 20-30% or 30 to 40% something which they are saying that conservative number is 30-40% which can come to the market of trading. So that then the market becomes only 20 billion carbon credit, but 20 billion is huge if you see per year for next 1 to 5 years. It's not about 5 years. A span of 5 years, it will go up to 100 billion credits. Out of 100 billion credits, this company does not even 100 million. So the market is huge if they want to grow from here. But saying that market is huge doesn't mean they will get entire market. There is possible risk also. So what is the risk? Risk is changing global policy. As we have seen throughout the video, the entire CCT is depending on right now on one thing, that is Paris Agreement. Second thing, the people who are part of Paris Agreement, the countries are part of Paris Agreements, whether they will be actively following the guidelines or following their agreements or pledges what they have done in the uh, Paris Agreement. If they don't follow, if there is a change in global policy, if some country change the policy, they don't want to become of this, and if Paris Agreement falls like the what happened with Kyoto Protocol, in that case, this market might not grow as fast as the opportunity is there, or as we think that market can grow based on environmental factors. So a lot of things depends on global policy. Second risk is big fours. The big fours are PwC, PricewaterhouseCoopers, KPMG, Deloitte, and EY. So they are the big fours of consulting in the entire world. As of now, these guys are shying away from this kind of carbon credit trading consulting. As far as I know, they don't do this. But if this market is so huge, and the moment they see there is a big growth in the market, they might jump in. Right now, this market is it's huge. Its potential is huge. It's been talked about. There's a lot of potential, but there is nothing much significant happening. It's progressing in the right direction, but nothing much significant happening. So this is keeping away these four big fours. But the moment you see there's a huge potential, these four big fours will come one by one, and then they can take a major market share out of the entire market, because they do major all kind of consulting in the world, almost everything they are there away. But the moment they see this is a big opportunity, they will definitely jump. Any business will jump, right? So this is a big possible risk for EKI, because EKI is nothing compared to what PwC and KPMG are right in the global market. So this is a big risk. Major risk one of the is growth of renewable energy sector. So solar panels, then EV. So this kind of emission product emission kind of products which are not into emission kind of thing or doesn't create pollution. The more they increase, the lesser the carbon credits are required. For example, Tata Power, they are saying that by certain year they will close all their coal-based power plants and they will go shift towards renewable energy power plants, right? So the moment there's this kind of things happens, these companies which are into right now creating pollution, and then they'll stop creating pollution, so they'll not need carbon also. So if they not need carbon credits, then this kind of companies which does carbon credit trading will not be in the picture. Okay, so this is also a risk. Now this big risk, this particular risk which I'm saying is the risk, is the growth in the renewable energy sector. This risk, if you see, this risk is not an immediate risk, even no matter what people say, but make EV as a next big thing, or removing coal from the power sectors can take other 20-25 years for that to happen. That means this is a risk, but this is not some risk which is happen immediately. Global policy, which also I think it cannot happen immediately, because every country is very much focused on environment friendly, because pollution is everywhere, and this is hampering a lot. What is the biggest risk for this company I see is this one. So this can be a bigger risk for, is the moment the market becomes very big, these four will definitely jump. And this is how IKEA protects itself from these big four, is something which you need to look out for. If you look into the conference letters or con call letters of IKEA, they are saying that the market is very huge. Okay, they are not saying that big four will not come. They are accepting it that big four might come, but they are saying that market is so huge, 100 billion carbon credits, that even if big four comes, there's enough market for us to survive and make money. And since they are a front runner, like not the front runner, but they are early into the market, they have a better experience and they have a better opportunity also compared to the big fours. So they have enough market to play along with the big fours. This is what IKEA is saying. So this was my entire video for this particular company, or more than companies, about the entire sector. Okay, they have some competitors also which are listed in the stock market, but they have not grown as fast as IKEA has grown, and IKEA has become market leader from India in this particular sector. So we've seen the particular ESG, then why carbon credit trading, how it works, how EKI fits in that, how EKI does, what is numbers, what are the strength of it, how it can grow, and then possible risk, why it cannot grow also, or what can temper its growth. So seeing the entire thing, but still ask you, go through the videos, do some research on yourself before making any decision whether to invest or not invest. And if you like these videos, do help me by liking the video, share with your friends and family, and give valuable comments in the feedback. So valuable feedback in the comments, so that it becomes more helpful to people also, and me as well. Thank you so much for watching. Stay happy, stay safe.